My name is Vic Kruger, and I'm a partner in the Calgary office corporate recovery practice. And among other industries, I've had a long history of working with financial issues affecting the ag industry. Jonathan Small of our Farm Management Consulting Group will provide us with his insights as to what is happening with certain segments of the agricultural industry. We encourage you to ask questions by entering your question in the Q&A box on the top left-hand part of your screen, or email Jonathan or me at the email addresses shown at the end of our presentation. We will try and answer any questions received if time allows at the end of our session. Now, without further ado, you're up, Jonathan.
Good morning, everyone. I hope I've got my mic on unmute. You can hear me all right, Vic?
Yes, Jonathan, thank you. Sorry, everyone. Jonathan is in his Red Deer office and participating from there.
Yeah, no, Vic's just not sitting just across the table from me. Okay, so without more ado, I'm going to talk a little bit. Most of you have probably been on these before, so at a pretty high level, talk about what we're seeing, what we're watching, and so on, and some perspective in the industry, and then a little bit about our people and some of the things that we do. So I think we'll launch straight into crops. I think the dry conditions in the prairies, were probably causing concern up until a couple of days ago. We've had some pretty good rain come through in the last few days. Certainly in Alberta, southern parts of the prairies, seeding is already underway, probably a week or two earlier than usual in a lot of cases. And we'll watch that situation carefully. Hopefully we continue to get some good rains. For the most part, markets and global markets have been pretty bearish, with commodities mostly tracking sideways or even slightly down until probably about a month ago, and we began to see some rises in commodities. I mean, the ones we watch most closely being, of course, corn and soybeans, because they drive a lot of the Canadian commodities. And so despite, market fundamentals, we saw upward movement in a lot of places, and a lot of that appears to be due to what we describe as money flow. So quite a lot of speculation by traders who were mostly pretty short, and they're trying to get longer positions. So it remains to be seen how long that run will continue and how high it goes. I think the caution to active producers of commodities is not to get caught in what we'd call a whipsaw, with the market rising very rapidly on the back of speculation, and then equally quickly coming to the realization that they've risen too far and too fast, and they come back down equally fast. So hopefully producers will take the opportunity to get some of that action. The other thing is, of course, in one of the major corn, soybean producing parts of the world, South America, where, of course, their seasons are out of step with our own, we've got some significant events going on, and that's fueling speculation. So obviously we've got political turmoil in Brazil, and quite dry conditions in the corn producing areas of Brazil, which leaves some question marks over South American supply and is obviously a help to American prices. And Argentina, conditions too wet in some of the major soybean producing areas, so with similar effects in North America. So we're watching those situations pretty carefully. And against that backdrop, of course, we've had Canadian dollar has been comparatively weak, and that's taken away some of the pain in Canada, at least. I think the other thing, and we mentioned this in the last webinar, we note probably something like a 40% inflation in mechanization costs on Canadian farms. Actually, I think similar situation in the U.S. as well since 2008. And obviously that's a concern. Those are costs that are locked into the system, making producers less resilient to major price swings and so on. As far as safeguards are concerned, watch that equipment ratio. Certainly in Canada and Western Canada, we look for an investment in machinery of $300 to $350 as being a maximum. Less is better, up to a point anyway. And we frequently see ratios at the $500, $600, and $700 range, and those farms are very vulnerable to any kind of bad luck that might be going around. And then also, of course, insure property of the creditor is included on that debt security. We frequently find gaps in special situations where items are not registered. Also ensure the proper registration of land. Also, we sometimes find gaps there. And last but not least, verification of crop insurance and agri-stability status, especially if markets do whipsaw, or in fact if we resume the trend that we were seeing in March and before, we may not have particularly high prices this fall for the new crop, and this could be a year when agri-stability will be important. Last but not least, La Nina, which typically follows an El Nino. No strong evidence yet that we're going to have a La Nina, although odds are, based on history, that we will. That's generally going to be challenging for U.S. soybean crops. It typically means warm and dry in August, when the U.S. crop is mostly maturing. So we also have to watch out for that factor and see how that develops. Moving on to supply managed. Obviously, in the last webinar, we had just had the TPP announcement. We were in the midst of an election campaign. And I think we remain of the view that probably the combination of TPP and the European deal, the CETA deal, which was signed a year before, will probably be mildly negative for dairy in Canada. Not catastrophically so, but it is going to be challenging, I think, in the dairy industry. And probably results in a slight break to progress on the poultry side, but nothing catastrophic there. Poultry market growth has been very substantial in the past year as consumers have continued to move away from what was seen as very expensive beef. I'll come to beef in a minute and what we see coming there. And the poultry industry has, certainly the broiler meat and the turkey meat industries have exploited that. Having said all of that, with the uncertainty over TPP behind us, we've seen quota prices strengthen, especially on the dairy side, as certainly in those regions of Canada where there is a free market in quota anyway. And we've seen quota prices recover. They had softened and even weakened slightly during the year or so before. Overall, outlook's probably pretty stable, but as we all know, that's a highly leveraged industry. It's a comparatively low ROI and low margin for error, and we see frequently even small issues can give operations, as you've seen, I'm sure yourselves, give operations very serious debt service issues very quickly. Overall, understand the quota, understand the provincial legislation, which is different from province to province in regards to transferability, the ability to buy and sell. Understand the particular debtor's own utilization and their options to lease out underutilized quota, which can make a difference. Understand the compensation rules. We observed last time that although TPP was announced by the Harper government during the course of the election to great fanfare, they also announced a significant compensation package to go with it to offset the effects of TPP and CETA. That was not part of the TPP deal, of course. That was a conservative election pledge, and as we know, they did not win that election. So far, the Liberals have been comparatively silent on whether they will honor that. And of course, we note they're planning on running a pretty large deficit. I don't know what their appetite will be to add a further $4.5 billion to that in the next 5 years. So we need to watch that carefully as to whether that compensation will in fact come through in the same form that it was announced. Last but not least, on a lot of those supply managed, certainly on dairies, but also on some of the poultry operations, we find those, of course, who have some land, and the dairies typically do, high land values typically support the security position when the quota is substantially leveraged. Moving on to cow-calf, this is an interesting situation. So we have the great North American cattle cycle is progressing in its inevitable way, where we're probably past the peak of the last cycle and starting the journey down towards the bottom, which, depending upon how long you think the cycle is, probably lies between 3 and 5 years in our future. So the rebuilding of the U.S. herd, which you've been watching for a while, is now well established, and rebuilding is also underway in Canada. And anecdotally, certainly, we meet a lot more producers at this time looking at expanding their herds, and that's usually a signal at ground level as to what's going on. Of course, beef prices are responding. So we're seeing downward movement as the feedlots, of course, who are in the front line of falling beef prices at the packing plants. They have to bid the price of calves down, and we'll see that trend continue. And we certainly expect to see calf prices from the 2016 crop to be substantially lower than a year before. We could easily see $600 to $800 come off the calf price this fall, which will make a big difference to profits and cash flows on cow-calf operations. Safeguards, obviously, and these are going to become more important because some guys are going to get caught offside by this adjustment that's underway. So performing walkthroughs on short notice just to make sure that the cattle which you believe to be there are actually there. Verification of inventory, and even requiring manifests to back that up to show proof of purchase or sales, and examination of the inventory values in use. Some people will inevitably be tempted to not reflect market prices in their inventory values, or to inflate the size of the cattle in order to show a stronger balance sheet. Verification of agri-stability and risk management practices, that's going to come to the front now, I think, as we go through this period of adjustment in the market. At the other end of the spectrum, of course, feedlots. I put this chart in here because it very aptly describes what are comparatively slender margins in this industry. The last 10 years have averaged about $18 a head on profits in feedlots. So that's not a lot to play with. That's not a very forgiving margin for people who get their risk management wrong, and we'll be watching that pretty closely. You see the dotted line there is the Canadian dollar against the US dollar, and there are relatively few of those blue bars showing years when the feeding industry has actively made a profit. So they need to make lots when the times are good, because they have to sustain all those years when they're below the line. And right now, today, the feeding margins are not good. In fact, they're negative in a lot of cases. Moving on, so at a high level, so we've seen feeder margins shrink. Falling prices are going to spell trouble for the poor risk managers in this industry. There are few of those around because they've been caught out by previous cycles, but there's certainly going to be some out there who've inevitably sailed too close to the wind. And of course, during the good times of sort of 13 through 15, risk management was not front of mind for them. They could make money with the minimum of risk management in place. If they don't restore some sort of management as prices fall, they get pretty badly caught out. The other thing is, of course, the very high beef prices which producers have enjoyed both sides of the border in the last 2 or 3 years have have probably eroded their market share significantly. That's the flip side of what we've seen on the poultry side, which is, one of the alternative meats of choice. And for a while, pork was also in the same boat as beef. It was seen as expensive by consumers. I think it remains to be seen how many will come back to beef as it becomes cheaper. Some certainly will, but the long-term trends on red meat consumption, which continue to be down, I think will remain that way, and that obviously means there's less room for the less profitable producers. Safeguards, verification of inventory, and requiring manifest once again to prove purchase or sale. Certainly on the sort of medium-sized feedlots, it can be a very confusing picture as to who owns what cattle in there. The larger, more sophisticated operations are usually pretty good at their inventory management because a major part of their business sometimes is custom feeding, and they need to keep their customers happy that they can identify their own cattle. But verifying agri-stability status and whether CPIP contracts and so on are actively in place to manage price risk, because that's going to be a big deal as well in the feedlot sector. Obviously correctly ensuring that land is captured in the loan documents and registered at land titles. Often these feedlots have significant land holdings too. And as I said, check those risk management practices for the customers who are on a more marginal basis. Moving on now into hogs. The hog industry in the U.S. continues to rebuild. There was an interesting reaction to the PEDV outbreak, which has been going on in the last year or so in the U.S. particularly, which was that the way producers responded to that was to start to accelerate the building of the herds to offset the lost production per sow. So we've actually seen a very rapid build-up in the herd, and for the first time since 2008, the U.S. herd is over 6 million sows. Obviously, that bodes badly for prices, of course, because that means the pork supply is rising very rapidly, and we'll certainly see that going forward. The low Canadian dollar has offset some of the pain in Canada, but it can't offset it all. So we expect to see Canadian margins shrink. Probably the summer barbecue season is going to put that pain off until the fall, but certainly once again we'll know the usual suspects who are high-cost producers. They'll certainly be posting some red ink by the fall, we expect, and it remains to be seen where this particular dip in the hog cycle will finally bottom out. Safeguards, of course, walkthroughs at short notice, and really assessing the condition of the herd and the barn operations. Certainly been a feature where we've become involved in bad situations that things have deteriorated very badly inside the barns, where nobody has really taken a look. It's obviously can be understood why people don't want to go in barns and look at hogs, but it's a major issue in struggling operations, and certainly be recommended that you get eyes on the ground with anybody that you're concerned about. Verification of land and farm equipment, of course, once again, it's a gap we find constantly when we become involved, and also verifying agri-stability status. At one time it may have been considered not a major program in the hog industry, but this last cycle has probably seen some rebuilding of agri-stability margins on hog operations, and therefore the agri-stability program could well be a factor if there's another serious dip in market prices. Moving on to Agri-Food. Really, the last decade has shown, certainly in Canada, this has been almost a bulletproof sector. It's pretty healthy. It doesn't grow fast, but it does grow pretty steadily. We think the outlook is generally pretty promising. In the next 50 years, the world's going to have to produce as much food in the next 50 years as it produced in the last 10,000, which is staggering to think, and a lot of that is going to get processed. So it's probably pretty good long-term outlook for this sector. The TPP is probably mildly positive also for the Canadian industry, and TPP mostly has benefited agriculture and food, probably more so than most of the other sectors, from a Canadian perspective anyway. But it's not all bed of roses. There's obviously some challenges out there. We note two fairly significant filings for bankruptcy protection. Agri-Food Economic Systems and Ceylani Sweet Cheese, recent victims, and it looks like their challenges were somewhat at least related to their ability to keep up with their customers, being supermarket chains and so on, who want ever more scale, and that trend will continue. So they like to deal with similar-sized suppliers, of course, understandably, and suppliers who can grow with them. And if you get, you can easily get left behind in that game, and these two apparently did. On the safeguard side, obviously being sure that there's no CFIA warnings or proceedings, or that there's no food recalls. Those are immensely destructive things in this sector and can often be the difference between life and death in business terms. Check whether there's enterprise risk programs in place is a good safeguard, because in theory those should protect against those kinds of issues. Moving on, I think next section would be greenhouses. The outlook's pretty stable in Canada. There's certainly consolidation underway, and local food trends, as they catch on, will certainly help. But obviously the major challenge in Canada is our climate, and therefore how we offset the effects of climate, which is our energy costs. Obviously, with natural gas prices still being low, that's favorable to this sector. But we continue to be challenged by lower labor costs and lower energy needs south of the border, California and Mexico being the major competitors for Canada. So that demands that Canada remains at the forefront of energy use, efficient energy use, and they do. Traceability technology is also increasingly important from a consumer perspective and so on. And once again, Canada is maintaining its edge by being better at that than its competition. So there's certainly room there. There's also some very old capacity dotted around, and it remains to be seen how much of that gets renewed as it reaches the end of its life. And that will be a driver on the consolidation side, we think. Once again, the weaker Canadian dollar has somewhat leveled the playing field with the US and Mexico. So verifying agri-stability status, this sector does qualify for agri-stability. Verification of proper registration of land and related farm equipment. It's notable that in this sector, certainly close to the population centers, where you often find that the greenhouses are not so much involved in food production, so much as supplying consumer goods for gardens and the like and so on, and that can be, when it's well managed, can be highly profitable. Often, because of their location, they also occupy some very high-value sites, and that's not to be missed, of course, where that's the case. Moving on to wineries. Near and dear to many of us, of course. So interesting, the difference east and west in Canada. So in British Columbia, 2014 and 15 enjoyed pretty good back-to-back harvests in British Columbia. Ontario, not quite the same. Actually, 14 and 15, if anything, were slightly short crops, but they carried in big inventories from 2013, which has sustained them pretty well through the shorter crops of 14 and 15. Most of that 13 inventory has gone through the system now, and to the point that actually the 2015 vintages in Ontario are already being marketed, which is unusually early. So they are hopeful that they can rebuild inventory in 16. The mild winter certainly says that there may be a good crop. Obviously, there's a long way to go yet before that crop is harvested and is into the vats, but the outlook at the moment says they could be on for a decent-sized crop in 16. Interestingly, of course, political developments in Ontario and the recent decisions to allow wine sales in grocery stores is stimulating. So the industry is pretty excited about this, and it has actually been stimulating some plantings in anticipation of increased sales that will come from that change. And last but not least, we note, certainly locally in Ontario, some significant purchases of Ontario vineyards by Chinese buyers. I'm not sure that we see the same thing going on in British Columbia, but that would be entirely possible, of course, especially given its greater closeness to China. Those purchases have been at all levels. So some significant long-standing brands have been sold, but also lower down the scale. There's been interest from Chinese buyers who are looking to, if nothing else, to improve their credibility in China. That the Canadian product is regarded as higher quality and more reliable and safer. So that seems to be the reason for the interest in Canadian wines. On the safeguard side, verify that inventory. And verify the values that are in use for it. While that until a vintage gets marketed, its value is very much a point of speculation, and it's very easy to inflate those to strengthen balance sheets. Might seem like a no-brainer, but confirm the terms of the license are being met. Obviously, the loss of the license is catastrophic in terms of the effect on the balance sheet and the business. And generally speaking, because of the long-term nature of the industry, longer-term business plans are probably in order. So be looking for sort of rolling 5-year plans from your customers, and if possible, get some third-party input into those. Primary downfall in this sector seems to be cash management and inventory management going wrong, where they run into trouble. I think that wraps up the various sectors. Here's a little bit about us. Obviously, agriculture is tremendously important to MNP. It was the foundation of this firm when we began in Brandon back in the 40s. And still today we have a very substantial client base in agriculture. It's still over 20% of our business. That's diminished over the last 15 years or so, as we've expanded in a lot of non-agricultural areas, but certainly in dollar terms, it's continued to grow and grow. Many of you would know, especially in the West, the Hutterites are a major client for us. It was actually the very foundation of MNP in Brandon, Manitoba. So we also count significantly more than 300 Hutterite colonies amongst our client base. So we've got something like 60 years of service to agriculture, and that's given us pretty unparalleled and unrivaled access to not only the industry at a producer level, but all the way through to industry associations and government, and obviously the value-add sector as well. So today we have probably over 85 offices now, which go coast to coast. We're finally a Canadian firm after some recent mergers in the East. So from sea to shining sea, as they say. We're a member of Praxity Global Alliance, which gives us a worldwide presence, of course. And we would be the only professional accounting firm in Canada with a dedicated farm management consulting group, of which, of course, I'm part. But that means we've got specialists located in all of those areas where it's necessary to meet the needs of our agricultural clients, predominantly because of our origins, that's the prairies. Overall, we've got something like 600 professionals within the firm focused on the agricultural industry. Many of them do nothing but agriculture. So we've got specialists, of course, like me, in farm management, in crop production, livestock production, a significant specialization in farm programs, which I'll talk about in a few minutes, and obviously agriculture-specific accounting and tax. In fact, within our tax group, we have individuals who specialize in agricultural tax and do almost nothing but that. Obviously, presence in food and ag processing is significant and growing, and as I already mentioned, the Hutterite colonies in the west of Canada. On the farm programs, probably of special note here It's a complex and highly specialized service line for us. We have several hundred file preparers who work every year on now over 9,000 applications, and within the firm we have 100 internally certified specialists to prepare and review those 9,000 applications. And we'd be the only firm in Canada to take a full-service approach to farm programs, and by that I mean we not only complete the forms. There's lots of people who will complete the forms out there for a fee and will send them in, but all they do is fill in the boxes. We don't believe that makes the program very useful, and we've always striven to take the understanding to a higher level. And so when we complete an application, we expect to tell our clients what we're claiming on their behalf, and we expect to be right 90% of the time. That makes the program a lot more bankable. So when you look at an application that's prepared by us, or you're dealing with a customer for whom we prepared that agri-stability, you can know with some confidence that there's a very high probability that what we've said is going to be claimed is actually what's going to show up. And certainly that also enables us, where the payment isn't what we expected, enables us to understand why not, and whether we should go to bat for that client and challenge that outcome, and we frequently do. We're also the only firm in Canada with the ability and the willingness to analyze the interaction between the various risk management programs. So that enables them to be truly used in a proactive manner to manage risk on farm. We have a special tool we developed in the last year for that purpose, and we're happy to talk about that and to give demonstrations of how that tool works, because we believe it's a game changer. Our own people within the farm management consulting group, we've got around 25 to 30 individuals who work in our group, and they bring to bear a combination of on-farm experience and formal qualifications in education. So things like, they're mostly a lot of bachelors of science in there, a lot of professional agrologists, of course. We've got not a few who are actively involved in farming today at a professional level. Same would apply actually amongst many of our ag specialist general practitioners on the accounting side too. A lot of those farm. And not a few certified agricultural consultants within our team as well. And we've got experience really across many sectors. You see many there. So we've generally got somebody somewhere who can answer almost all of your questions. And then last but not least, why am I doing this presentation in conjunction with Vic Kruger and his group, of course? Well, that's because we frequently work with the corporate recovery services of the firm, and our own team has assisted with the initial assessment of debtors, monitoring, restructuring, and liquidation. And certainly right now today we're involved with a number of files looking at the assessment of debtors. The team itself have been actively involved in the following kinds of services with the corporate recovery team. So we've assisted with, obviously, the taking possession of farm operations, making sure that we cover all of our bases. Obviously, then helping that team to determine and execute strategies on the ongoing operations where we have to keep operations going, especially where there's livestock concerned. Providing executive management of the day-to-day farm operations in those situations, obviously consulting on key decision points in those farm operations, helping to prepare risk management analysis and mitigation strategies where necessary, and last but not least, providing input into the realization plans where those are necessary. So that just about sums it all up. You see my contacts there. And Vic Kruger's happy to take questions, and happy to talk to any one of you. And thanks again for joining us this morning, and hope you have a great day.
Thank you, Jonathan. Are there any questions? Jonathan, you talked for a number of industries. You talked about risk management procedures. Do you want to expand on that?
Well, I could do probably a 2-hour presentation on that if you wanted, if everybody's got the time. I'll just fire up another PowerPoint. But agriculture is a risky business, and risk is just, risk is uncertainty. And for the most part, our view would be that agricultural producers are in a risky business. Most of them don't understand what risk is terribly well, and they fail to measure both parts. Fail to even realize that there's 2 parts. So there's probability and impact, and they're mostly focused on impact, which is not hard to quantify in a lot of cases, but they have no perspective on probability. And so and we believe that you're not truly managing risk until you're managing both of those things. So I'll give you an example. So decisions about whether to use crop insurance or not are mostly based on a comparison of just an emotional reaction to the size of the premiums, without any real appreciation as to really what impact truly looks like, or indeed what the probability of things going wrong are. And so they don't have a complete picture. And it's records really that is what enables individuals to be subjective about their risk management practices.
Thank you, Jonathan. If there aren't any other questions, I just want to let everybody know that we have recorded this webinar, and the link will be sent to you, as well as the webinar will be posted to our MNPdebt.ca website. We intend on holding our next webinar this fall, but should any issues of note arise before then, we will send out a specific notice. And if you haven't been asked to be placed on our distribution list to date, and you would like to be added to our distribution list, please send me your request to my email address. So thank you all for attending, and this is the end of the webinar. Goodbye.